There's a quiet tension building in the silver market that most investors don't fully understand yet. On one side, you have the physical metal, bars, coins, industrial inventory, moving through refineries, vaults, and supply chains. On the other side, there's the paper market, a vast network of futures contracts, ETFs, and derivatives where silver is traded in quantities that dwarf the actual metal available. And increasingly, these two worlds are moving in opposite directions. The price you see when you check silver isn't really being set by someone buying a bar from a dealer. It's being set by contracts traded on exchanges like the COMEX, where the majority of participants never intend to take delivery of physical metal. They're managing risk, speculating on price movements, or hedging positions in other markets. This system works smoothly when physical supply is abundant and demand is predictable. But when those conditions change, when the physical side tightens while the paper side continues operating as if nothing has shifted, that's when things start to fracture. What we're seeing now isn't a sudden collapse or a dramatic headline event. It's something more gradual, but potentially more significant. Refiners are reporting extended wait times. Mints are rationing product. Dealers are facing persistent premiums well above spot price, meaning the actual cost to buy physical silver is often several dollars higher per ounce than what the futures market suggests it should be. And this isn't a brief spike driven by retail panic. It's been sustained, month after month, through different market conditions. Now layer on what's happened over the past few years. The push toward green energy and electrification has accelerated industrial silver demand significantly. Solar panel production alone has become one of the largest sources of silver consumption, and projections show that demand curves steepening, not flattening. At the same time, mine production hasn't kept pace. Silver isn't typically mined on its own. Most of it comes as a byproduct of copper, zinc, lead, and gold mining. So silver supply is somewhat constrained by the economics of these other metals. When base metal prices are weak, or when miners are cautious about capital expenditure, silver production doesn't just expand to meet rising demand. Meanwhile, investment demand has also been climbing. Retail buyers, institutional players accumulating physical through ETFs, and central banks in some regions treating silver as part of their reserve diversification. All of this has layered additional pressure on the physical market. But here's where it gets interesting. Despite this tightening in the physical realm, the price hasn't exploded. It's been volatile, yes, but constrained within a range that doesn't fully reflect the supply stress observable on the ground. This is where the paper market comes in. The futures market provides liquidity and price discovery, but it also allows for leverage and for positions that far exceed available physical inventory. Estimates vary, but some analyses suggest that the notional amount of silver traded in derivatives markets is multiples higher than annual global production. That's not inherently problematic if those contracts are mostly settled in cash or rolled forward, but it does mean that price formation is heavily influenced by financial flows, sentiment, and positioning in the futures market, rather than by the underlying physical supply-demand balance. When a large institution wants to gain exposure to silver, they might buy futures contracts or shares in a silver ETF rather than taking physical delivery. When a miner wants to hedge future production, they sell futures. When a trader wants to express a macro view on inflation or the dollar, they might use silver as part of a broader commodities trade. All of this activity affects price, but none of it directly interacts with physical metal in the moment. The system essentially operates on the assumption that if delivery were demanded, the metal would be there. But what happens when that assumption is tested? There have been moments over the past few years where the system has shown strain. In early 2021, retail investors organized a coordinated buying effort targeting physical silver, trying to force a supply squeeze. Premiums spiked, dealers struggled to source product, and mints ramped up production as much as possible. The price moved, but not to the degree many expected, partly because the futures market absorbed the pressure through increased open interest, and partly because large holders didn't panic. The system bent, but didn't break. Yet the underlying tightness never fully resolved. Inventory levels in COMEX warehouses, while still substantial, have been more volatile. Registered inventory, the portion available for delivery against futures contracts, has fluctuated in ways that suggest careful management. In London, another major hub for silver trading and storage, similar patterns have emerged. There's metal in the system, but it's not sitting idle in unlimited quantities waiting for anyone who wants it. The question that looms over this dynamic is what happens if the gap widens further? What if industrial demand continues to accelerate while mine supply remains constrained? What if a significant portion of ETF holders who currently own paper claims on silver decide they want physical delivery? What if geopolitical instability or currency concerns drive a sustained wave of retail and institutional buying of coins and bars? The paper market can theoretically accommodate almost any level of speculative interest, but the physical market has hard limits. Some analysts argue that the current system is unsustainable, that the mispricing between paper and physical will eventually force a reckoning. Others believe the market is functioning as designed, that premiums and delivery delays are normal friction points, and that price will adjust upward over time if physical tightness persists. The reality is probably somewhere in between, but the structural tension is real. One thing that's changed is awareness. More investors now understand the difference between owning a futures contract, owning shares in an ETF, and holding physical metal in their possession. They understand counterparty risk, the potential for cash settlement instead of delivery, and the limitations of paper exposure in a supply-constrained environment. That shift in understanding could itself become a driver of behavior, as more capital flows toward physical allocation. Central banks and monetary policy also play a role here, even if indirectly. When real interest rates are deeply negative, when inflation is running above target, when confidence in fiat currency stability wavers, hard assets become more attractive. Silver, being more affordable than gold on a per-ounce basis, and having dual monetary and industrial utility, becomes a logical destination for that flight to tangible value. But if that demand surge hits a market where physical supply is already stretched, the adjustment mechanism is unclear. The hidden crisis, if we can call it that, isn't that the system is about to collapse tomorrow. It's that the infrastructure connecting price discovery to physical reality is under stress in ways that aren't immediately visible in the spot price. It's that the assumptions underpinning the paper market, that delivery is always available, that premiums are temporary, that supply will adjust, are being quietly tested. And it's that the longer this disconnect persists, the more potential there is for a disorderly adjustment when the market is forced to reconcile. For anyone watching this space, the key isn't to predict a specific catalyst or a precise timeline. It's to understand the structural imbalance and to recognize that markets don't always adjust smoothly. They can remain mispriced for longer than seems rational and then correct abruptly when a threshold is crossed. The silver market, with its dual nature and its complex layering of physical and financial flows, is one of the more interesting examples of this dynamic playing out in real time. What makes this particularly worth monitoring is that silver doesn't exist in isolation. It's tied to broader trends in energy transition, monetary policy, currency stability, and investor psychology around hard assets. If the physical shortage deepens, if industrial demand continues to outpace supply, if investment demand accelerates, the paper market will eventually have to respond. The question is how, and whether that response will be gradual or sudden. The narrative around silver has often been colored by speculation, conspiracy theories, and exaggerated claims. But strip that away, and what remains is a straightforward supply-demand story, playing out in a market structure that wasn't designed for the current environment. The physical market is tightening. The paper market is providing liquidity, but also masking that tightness. And the gap between the two is growing more apparent to those paying attention. This isn't a call to action or a prediction of imminent crisis. It's an observation that the conditions are in place for something interesting to unfold, and that understanding the mechanics of this hidden tension is valuable, whether you're an investor, a market observer, or simply someone trying to make sense of how modern commodity markets actually function. The silver market is telling us something about the limits of financialization, about the difference between price and value, and about what happens when paper claims proliferate faster than the underlying asset they're supposed to represent.